Good morning and welcome to your Tuesday, 5th of March market news update. The Chinese government announced a GDP growth target of 5% for the 2024 at the annual National People's Congress. Gold extended its winning streak, adding almost another 2% to its rally and now heads for the $2,145 all-time high peak. US equities wobbled yesterday as mega cap stocks performance slacked. Japan's Tokyo Core CPI confirmed the acceleration of inflationary pressures to the 2.5% level in February. Crude futures pull back below the $80 per barrel level as bears place bets that stronger supply will overpower OPEC Plus cuts. Next test for the dollar is the incoming ISM non-manufacturing PMI result for the month of February. Aussie traders brace for Australia's fourth quarter GDP result in tomorrow's early Asian session. That's all for now, and stay tuned for tomorrow's market update.
Hi everybody and welcome to another daily presentation. This is the market overview for the 5th of March of 2024, and these are the key events that you should familiarize yourself before starting your own trading day. Now, the first topic of conversation is going to be about the dollar's muted reaction ahead of a packed week. So the dollar index has been trading in a tight range near the 103.50 level over the past 10 sessions as traders brace for incoming data on multiple fronts, including political, monetary, and economic events. Now, today we note the quote-unquote Super Tuesday event taking place in many states where delegations hold primary elections on who shall represent each party to this year's presidential race. And according to gathered polled opinions, Trump is expected to be the Republicans' pick. And for the Democrats, most likely scenario will be President Biden running in opposition. Now, the other political event that takes place on Friday, and it's the State of the Union speech, where the incumbent President Biden appears before Congress to comment on how the country has performed thus far and what are the plans for the year ahead. Now, from a monetary level, we note Fetcher Powell's speech or Fetcher Powell's testimony before the Senate and the House of Representatives taking place tomorrow and the day after that, who could face scrutiny from lawmakers in regards to the central bank's policy practices. But traders will primarily focus their attention on any given comments from Fetcher Powell regarding future policy plans, as the market has already positioned itself for aggressive rate cuts in 2024, whereas we see on the contrary Fed policymakers still maintaining a kind of cautious stance in regards to policy easing. So from a monetary point of view, this is the event that we expect to yield the most kind of reactions from in not only the FX market, but also bond markets and stock markets as well. So we will be placing primarily our undivided attention on this kind of event rather than the other two, but still the others are also of crucial importance. Now, on the economic front, today we note the release of the ISM non-manufacturing PMI result for the month of February, which be closely monitored since last week's respective manufacturing PMI result disappointed market participants as it fell to its lowest levels in over 15 months and broadcasted systemic deterioration worries. And shall we see a similar kind of tendency from the ISM services, in a sense, PMI result, we'll expect to see weakness in the dollar and strength for US stock markets and gold. Okay, so finally, the main event from the economic kind of class, if you would like, for this week is the upcoming non-farm payrolls report, which is coming up on this Friday, which will provide a status update on the surprisingly robust US labor market alongside the ancillary employment market reports from the ADP, namely the ADP non-farm employment report and the JOLTS jobs openings reports coming up in tomorrow's session. Okay, so data-packed week for the United States and therefore the United States dollar. We will keep a close eye on the developments, primarily on the monetary front, with a speech from Fed Chair Powell and the financial news releases coming up today, tomorrow as well. Okay, so enough about the United States. Let's move on to the next topic of conversation, which is going to be about the second largest economy of the globe, which is China. And more specifically, we're going to talk about the Chinese National People's Congress event that kickstarted today. So earlier today, the annual NPC conference started in Beijing, and a swath of officials made an appearance to hear keynote speeches that outline this year's economic goals, but also it serves as a catch-up on the current state of affairs. Now, Premier Li Qiang, the second in command, took the stand and presented the government's plans for support and the aim to boost its lagging economy. The plans also on how to tend a faltering real estate sector, but also create more jobs in the employment market, where the prime topics that were discussed, but also from our point of view, a critical or an important kind of development on the plans of Beijing officials to boost, in a sense, technology and science sectors in quote-unquote attempts to create a more self-reliant kind of state or progress on this kind of front, but also to stay, in a sense, on top of competition, with the main competition being the United States. Okay, so we see the narrative around strengthening domestic affairs in China. We see them addressing the problems that we see as well, meaning the real estate sector, lagging economy, and somewhat underperforming employment market. I also see kind of a future outlook or an outline of what to expect in the future, and this capital allocation of, if I'm not mistaken, nearly 10% of the GDP is going to go towards science and technology, which again gives you an indication that the Chinese party, Chinese economy much more generally, wants to stay on top of things and focuses their attention primarily on innovation, okay, stemming from technological advancements. Okay, so deflationary tendencies was another issue that the PBOC needs to tend, according to experts who foresee that the central bank is going to be forced, or at least being pushed towards slashing once again their key policy rates in order to revamp domestic consumption and prop up, in a sense, kickstart once again spending within the economy in order to move away from this kind of deflationary environment and return towards at least a 2% kind of inflation target. Okay, this is definitely no good news in regards to exporting stuff from China, but it's beneficial for its imports. So they see a deflationary problem being somewhat easy to fix, and the solution is to cut rates even further. We will see whether that is going to take place. So in regards also to the growth prospects, the government set its GDP target for 2024 at the same level as last year, so 2023, which was 5%. Let's not forget that the Chinese economy actually outperformed this kind of metric. We saw the latest GDP print for the last quarter of 2023 climbing to the 5.2% level, so higher than originally forecasted. But the fact that the Chinese authorities do not foresee an even higher GDP print in 2024, and they keep the target at 5%, may foretell that they don't expect the economy to, let's just say, get back to speed as quickly as the market anticipates, or they anticipate. So therefore, they went with a quote-unquote modest 5%. Let's not forget that other major economies, such as, for example, the United Kingdom, Germany, the UK, Canada, and Australia, are indeed struggling with their growth trajectories. So we see 2 out of the 4 or 3 out of the 5 being in a recessionary kind of territory. So I don't know why people get disappointed with the 5% growth target from China. So yeah, that's something else we need to put on the agenda. So nevertheless, the 5% target, the unchanged 5% of the target in regards to growth, partly disappointed Chinese traders or investors, international investors that were bullish on China. And for the time being, we will see whether the Chinese economy is going to outperform once again or, in a sense, validate these kind of calls for disappointment. Okay, for the time being, we see China outperforming. We will see how incoming data kind of alters that. Okay, so on the fiscal front, we heard from authorities announcing that the fiscal deficit towards the GDP is going to be around 3%, which is below the 2023 targets, and fiscal expenditure is projected to rise by 4%. But at the end of the day, it's below the 5.6% target that they had in 2023. So mixed kind of projections here in regards to the fiscal aspect of the Chinese authorities. Okay, so lastly, let's finish up with what is going to be the most critical event coming up from China later this week, at least from the financial standpoint of view. Is going to be the trade balance results for the month of February, which are coming up on Thursday early in the early Asian session, which will broadcast whether the giants exporting capabilities managed to expand for the third consecutive month and whether the trade surplus is gonna widen. Okay, let's not forget that Chinese exports have been underperforming for the past I'm gonna say 8 to 10 months, but on the past two reports more specifically, we see them the exporting rates escaping contraction territory and returning to expansion. If I'm not mistaken, exports for the month of January were around 2.5% or 2.3%, if I'm not mistaken. So we see them revamped, okay, rebounding from this kind of unwanted kind of territory, returning back towards expansion. We will see whether this kind of momentum is going to keep extending into the future. If yes, so we're going to get much more positive data coming from China, and we're going to see positive or at least support being given to the yuan, but also for Chinese stock markets, which have rebounded kind of nicely from 2015, 2016 lows earlier this month. Okay, partly because of the stimulus programs that the Chinese economy has rolled out, but also some key regulation changes in regards to capital markets in general. Okay, so for the time being, the upcoming event that we will place significant attention to are the trade data coming up on Thursday. For the time being, once again, this has been the end of today's session, guys. Thanks for watching, and we'll keep you up to date tomorrow if we get any new sort of information rolling in. For the time being, thanks for watching. We'll catch you on to tomorrow's session for another update. Take care. Bye-bye.
Hi everyone, and welcome to the earnings season section. And today we highlight the releases from NIO. NIO designs, develops, manufactures and sells smart electric vehicles alongside smart power solutions in China and worldwide, and is the 20th largest player in the automobile manufacturers industry according to market capitalization metrics. Analysts forecasted NIO missed its earnings per share target by minus 14 cents, yet beat its revenue target by $4.4 million in the fourth quarter of 2023. Point of interest will be the up-and-coming EV Challengers production and sales growth estimates. Can NIO stay on top of competition within China's domestic market? That's all for now, and thank you for watching. In this video, we will discuss currency pairs categories. Currency pairs are split into three main categories: majors, minors, and exotics. The major pairs are the most frequently traded in the foreign exchange market, and they make up the largest share of trading. The reason for this is that major pairs have the US dollar on one side, as it is considered the world's reserve currency. Even though the agreement to peg the US dollar to a rate of $35 per ounce of gold was replaced by the free market system, the US dollar is still seen as a global reserve currency. Examples of major currency pairs could include the euro against the USD against the JPY, the GBP against the USD against the CHF, and the USD against the CAD, and the AUD against the USD. The second currency category is the cross-currency pairs, or if you prefer, the minor currency pairs. These are currency pairs that do not include the USD and are also called cross rates or crosses. They are also known as minors, and the most actively traded are derived from the three major non-USD currencies. These are the euro, the JPY, and the GBP. For example, the euro against the GBP, GBP against the JPY, and euro against the CAD. The third currency pair category is the exotic currency pairs. These currency pairs are made up of one major currency paired with the currency of an emerging economy or a small economy from a global perspective, such as Hong Kong or Singapore and several European countries outside the Eurozone. Such pairs could include, for example, the US dollar against the South African rand, or the US dollar against the Turkish lira, or the euro against the Czech krona. It is worth acknowledging that trading in exotic currency pairs may offer greater returns. However, due to their volatile and sometimes unpredictable nature, such trades can also present a disadvantage. Additionally, trades who deal in such pairs may encounter problems with low liquidity and higher spreads.
Okay, so again, today we're going to move on with our technical analysis journey. Today we're going to visit moving average strategies much more specifically, and we're going to see what kind of information, what kind of signals we actually get from using moving averages. Okay, what are actually moving average first? We're going to do a small recap, how to apply it onto your chart and see whether it gives you some sort of indication, you know what, I'm going to buy now, I'm going to sell now, etc. Okay, so we're going to learn how to interpret these kind of signals, these kind of indications, and hopefully, again, you're going to use them in your own trading alongside many other indicators we have used in the past, for example, RSI, moving average convergence and divergence, momentum indicators using charting kind of tools, much like trend lines, support and resistance levels, and all that kind of stuff. So again, we're going to introduce the concept of moving averages. We're going to do moving average strategies, okay? And then we're going to add them all together into a live environment together to see how to interpret this kind of stuff, okay? So please bear with me for less than 1 minute. Hopefully it's going to be less than 1 minute. I'm going to go out and read out this disclaimer and the risk warning, and we'll be on our way. Okay, so our products are traded on margin and carry a high level of risk, and it's possible to lose all your capital. Now, these products may not be suitable for everyone, and you should ensure that you understand all the risks involved. Disclaimer is the information in this webinar shall not be considered as investment advice or investment recommendation, but it is for educational purposes only. Now, the material is just a personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. T4Trade is not responsible for any loss arising from any information contained herein, and the redistribution of the material is strictly prohibited. Okay, out of the question, out of the way, moving on. Technical indicators. Guys, if I'm moving way too fast, please let me know. I'm going to slow it down, but this is due to because we don't have much time left, and I've started this webinar late by myself, okay? So please let me know if that's okay from you. Now, technical indicators, we're going to do a small recap on technical indicators, okay? In the past, we've covered these way too many times. I've decided to split the function or the concept or the, not ideology, but yeah, what would you call it? This way of thought, this school of thought, technical analysis, the other one is fundamental analysis, okay? I've decided to split technical analysis into two easily digestible portions, which is charting and mechanical. So charting analysis uses trend lines, support and resistance levels, chart patterns, identifying gaps and all that kind of stuff. We covered this in the past. Whereas mechanical analysis uses technical indicators such as moving averages, which is the one we're going to use today, oscillators, envelopes and bands, and other technical indicators. Now, mechanical analysis, in a sense, is being performed by the use of moving averages. Again, topic of today. Oscillators, envelopes and bands, and other technical indicators. The aim of the technician is to establish the market sentiment by the help of these kind of pre-mentioned tools. Again, and we haven't gone into much more detail in today's session. Okay, no need. We're going to do moving averages. Now, technical analysts or chartists, that's another way of talking about those that use this kind of craft, if you like, look for technical indicators in historical price asset data or asset price data much more accurately to judge entry and exit points or identify them and in a sense use them to their advantage and place trades accordingly, hoping to make profit. Okay, there are several technical indicators that fall broadly into two main categories. We have overlays that go on top of charts and oscillators that go below the chart. Okay, you will see them in action soon. Technical indicators are known as technicals, okay, and are focused on trading data, price, volume, open interest, and many other parameters. These are the three main broad categories, if you like. And technical indicators are commonly used by not only active traders, but also from longer time frame kind of traders or position traders, you want to call them, you want to brand them as that. Since they are designed to analyze short-term price movements, again, long-term investors may also use technical indicators to identify entry and exit points or whether their trade is actually going in their favor and whether, you know what, maybe a reversal point is approaching and therefore I have to pay attention to and close my position, if that's one way of using technical analysis and technical indicators on a much broader kind of time frames, okay? But they're most commonly used in much shorter time frames from traders you could brand as scalpers or day traders, or at that extreme you can call swing traders as well, or speculators in general, okay? So again, on mechanical analysis, you have moving averages, Bollinger Bands, Ichimoku clouds, parabolic star, and Fibonacci. of the chart, we have RSI, moving average, convergence and divergence, ADX, the average directional move and momentum. Today, prime focus will be moving averages. Okay, so what are moving averages? Okay, so moving averages are, or moving average, singular, is one of the most widely used technical indicators. Pretty much it's super easy to decode, if you would like, or simple to understand. It's not, excuse me for one sec, easy to comprehend, understand, plot to your chart and use wisely. Okay, and in a sense it identifies if a new trend has begun, or if an old trend has ended or reversed. Okay, so notice here we're talking about stuff that happened in the past. Therefore, this the key takeaway here is that moving averages are not future predicting kind of indicators. Okay, they are lagging indicators. They compile information that was gathered from the past and they actually average that, hence the name moving averages. Okay, so they're moving, the thing that they're moving is the time period. Average is obviously adding all those kind of values together, dividing them by the number of the studied period, if you like. Then you get an average value that keeps track of the trend as it progresses through time. And the reason why we use moving averages is to keep track of the current trend, okay, or to see whether it has actually shifted or not. Okay, in a sense, moving average is the average of a certain body of data. The body of data is defined by the time period you will choose to study. Okay, we will do examples together to see how it changes. Now, for example, if a 10-day average of closing prices is desired, the closing prices of the last, obviously, 10 days are all added up, the values, and then divided by the 10, which is the period you have chosen. The body of data to be averaged moves forward with each and every new day, and hence the term moving. So, for example, if yesterday you were, for example, you're using a 10-day moving average. Let's take the one that we have in front of us. So you compile, in a sense, moving average compiles the last trading days, the last 10 trading days. It adds all the value, divides them by 10, okay, and gives you a value that you see today. Now, let's just say tomorrow, okay, this moving average will subtract the last, okay, the 10th day of the previous sample size, and it will add today's day into the mix, hence the term moving. It will do exactly the same thing. Take the last, at that point in time, the last day of that specific sample size, the 10th day, you push it one day forward, okay, and you add the new one. Add them all together, divide by 10, and you get the average of the day. And therefore, you get this kind of trackment of the price action, hence the name moving average, okay? Pretty self-explanatory, enough for me talking about this simple concept. Now, by averaging, the reason why we use averages is the averaging of price data gives you a smooth line, which is much more easily appealing to the eye to see whether the market is moving downside or to the upside. Okay, if that is not clear to the untrained eye, in a sense. Okay, which again makes it much easier to view the underlying trend. Now, a short-term moving average, and something that you can extrapolate from this, a short-term moving average would hug the price action or mimic the price action much more closely, obviously compared to a longer time frame. Okay, and you can see the plot, the snapshot of the graph I have on the right-hand side of the presentation here. So the greater the number of the time periods used, the greater the smoothing. So if you can make a conclusion or an observation just by just looking at this wide variety of time periods of these moving averages, you can see that the 200-day moving average is far away from the price action compared to a much smaller kind of time frame. Okay, and the line is much smoother. And for example, take the 10-day or the 20-day, you can see it mimics or it kisses or it flirts with the price action much more closely. Okay, mainly because it averages out a smaller kind of time frame. Okay, so this is, if you pull up a chart and you see a line that is way above the moving average, that is way above the the price action, and one that is much more closer, narrowing, much more closely mimicking the price action, you can make the reasonable conclusion that the one that is much smoother and further away from price action is what we call the long-term moving average, or the LMA, whereas the other one that is much more closer is the SMA, the short-term moving average, okay, short-term period moving average, whatever you want to call it, okay. Another key takeaway from studying moving averages, or at least the types of moving averages, they have to at least put them forth, okay. What kind of options do you have when it comes to applying a moving average to your charts? You have the simple moving average, which is the gold standard, if you would like, that was the most widely used by traders. Simple moving average, again, is the concept of just explained way in this slide. 10 periods, for example, for a 10-day period, you have 10 values, divide them by their number, which is 10, and you get the average. Whereas the linearly weighted moving average is the exponentially smooth moving average, the EMA of the VWAP. That's another way of conceptualizing the other one, okay. It uses, let's just assume that you use the same time frame, the 10 periods, the 10 days, is exactly the same thing. It's an average, but with the sole kind of difference being that the average value you will get will let's approach this from a different angle. You have 10 periods, 10 days, okay. The exponentially moved the EMA, the exponential moving average, will place much more emphasis on the the earliest 3, 4, 5 days rather than the past 10, okay. So you have 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. The exponential moving average will place much more weight in order to capture the sharpest or volatile price movements that mimic the current price or price action, okay. They will place much more weight or much more emphasis in the value, okay, of the most recent 3 days rather than the last let's just say 3, 4, 5 days, okay. So you place much more emphasis or more weight on the closer, okay, the much more recent price action, in order to capture much more accurately or much more nicely the abrupt movements of price action. And this is because you have to never forget this, okay. You have to always remember this, that moving averages are lagging indicators. They compile information from the past, okay. So giving more weight to much more recent, okay, time periods of that studied subset of that sample size, it gives you, quote unquote, a much more nicer edge, or a much accurate, quote unquote, representation of what happened with price action in the latest or the closest in the much more recent past, okay. So hopefully I didn't confuse you with this, okay. Same concept with the EMA, is the linearly weighted moving average, but most people use simple moving average. Does the same job, especially if you're using on a much longer kind of time frame. It's relatively speaking, it's not much difference. In shorter time frames, personally speaking, I like to use exponential moving averages. For example, on an hourly chart, on a 4-day chart, or even lower than that, half an hour chart, I like to use the exponential because it tracks much more nicely the abrupt kind of price changes. Again, it's up to your likings, okay. All of them are used for the same purpose, to identify the trend, okay. Let's not forget the basics. So again, obviously this slide encapsulates or reiterates what I just said. The moving average is a follower, is not a leader. It shows the market, it follows the market, excuse me, and signals that a trend has already begun after it has happened, okay, or a trend has reversed after it has happened, okay. Keep that in the back of your heads, okay. Now, in regards to strategies, now that we've covered what a moving average is, which is a basic, super basic kind of concept to grasp, okay, what are the options, or how are traders using moving averages in order to trade, okay. And I have here outlined 2 of the most basic ways of using moving averages as a strategy to enter the market and possibly capitalize on this and make money. Okay, so the one is using only one simple moving, or using one moving average, simple, exponential, whatever that is. The point is use only one moving average. And the idea behind this is all the parameters, all the specs, or the conditions. Okay, how you use the one moving average in order to, as a strategy, in order to make money, is that when the market closes above or crosses, much more accurately, above the moving average. Okay, so you have price action, you have a moving average above the price action, mainly because it has moving to lower ground. Once you see a candle or a day's price action breaking above the line, the single line of the moving average, traders use this as a bullish kind of signal. Okay, that gives you an indication that, you know what, we're moving past a period where the price action has been below the moving average and we're crossing into new territory. Traders consider this as a bullish signal and they enter long. Okay, they buy, in a sense, whatever that instrument is. Okay, hoping to capitalize on the upside. And also the flip side is also true. When you have price action breaking or crossing below the moving average line, the single moving average, the one you have, this is considered to be a bearish signal, and traders use this in order to place short orders and capitalize on the fall. Okay, so that's the simplest and easiest way of using a moving average. From my point of view, the more the merrier, because I like to spot, or I like to look out for or search for convergence between many different parameters. I don't like to go blindly and solely using only one tool and gives me one indication and I place a trade according to that. I like many stuff, okay, studying all these kind of different parameters and assessing whether they're actually giving me the same signal or they have some sort of divergence between them. Okay, much more accurately. So using only one moving average, it's kind of risky, but I've met many traders that actually go ahead and place accurate trades and make money most of the time when using only single moving average. Okay, not that sophisticated, much more simpler to use, and relatively free of unnecessary overcomplication, which is a common thing amongst traders. Okay, we tend to overcomplicate things and have way too many parameters to take into consideration, and you get paralysis by analysis. Okay, so that's one way of going at that's one, if not the simplest moving average strategy that you can encounter in the trading markets. Now, the other example I've chosen here is the two moving averages. Okay, so instead of one, you have two, and the main adjustment you have to make is that, in a sense, you search for not when the price action crosses above the moving average, that much like the first example we just gave with a single moving average. We're talking about, we want to see whether and when those two moving average lines you have plotted on your chart actually come together and cross one above the other. Therefore, in our case, when we're talking about two moving averages, you have what we call a long-term moving average and a short-term moving average. For example, a 100-period moving average with a 50-day moving average. Okay, so you need to have two different time horizons or two different sample sizes of moving averages in order for this to make sense. If you have two moving averages on your chart and you plot them with the same period of 100, obviously you're going to have two lines on top, stacked on top of each other, which are not giving you indications. So you need to have a small moving average and a long-term moving average, and what you look out for are the crosses between the two. Okay, so in a sense, when you have the short-term moving average, okay, the one that mimics much more closely the price action, you will see it in visually illustrated soon, so please bear with me. When you have the short-term moving average crossing above the long-term moving average, this is what we call a bullish crossover or a golden cross. This is a signal that price action may be accelerating and moving to higher ground. Whereas if you have the short-term moving average, again, the small one, crossing below the long-term moving average, we call this the death cross or the bearish cross, okay? Bullish cross when short-term moving average crosses above the long-term moving average, and you have the bearish cross when the short-term moving average crosses below the long-term moving average. Okay, hopefully this is simple to comprehend. Yep, you're going to see them in action soon if you have any queries. If not, if you still have questions, please send them through in the chat. Okay, so this is a visual illustration of a simple way of using two moving averages in order to trade successfully in this kind of case on a much longer time frame. Use this kind of moving average strategy, which gives you indications on when to buy and when to sell. Okay, so please bear with me for a quick demonstration. So if I'm going to ask you now, guys in the chat, which one is the long-term moving average and which is the short one, what would you tell me is the long one? Okay, the blue line or the green line? Okay, hopefully you're going to say blue line because, as we just mentioned, longer term moving averages tend to be smoothed. Hopefully you can see my pointer, are much smoother, and they do not hack the price action much like in the same fashion that a short-term moving average does. So the blue line is the long-term moving average, and the green line, which much more closely resembles or fit now much more nicely fits the price action, is the green one, which is the short-term moving average. So in this kind of case, we see the green line, if you can see, peaking and then crossing below the blue line, the long-term moving average. So the short-term, if you can see here, the short-term moving average crossing below, this is the second example, short-term moving average crosses below the long-term one. This is what we call a bearish cross or a death cross, which is a signal for selling, okay, going short. Okay, in this kind of case, you see the green line crossing below the blue line. You see the price action afterwards moving to that actual direction, okay? And you also see the gap between the two lines is something else you have to pay attention to. Once you see the gap widening between the two, that means there is bearish sentiment in this kind of case because it's moving to lower ground. You see spike in sentiment and momentum. That means the price action is actually moving to that specific direction, which is downwards in this case, in a much rapid pace, okay? And you can clearly see it here, falling steeply without finding support up until down there, okay? So the bearish crossover give you a signal that, you know what, the trend has indeed shifted, and in prior to this, it might have moving to the upside, has shifted. The bears are actually in control, and therefore you place a short order to capitalize on the downfall, okay? So placing a short order, let me get my scribbling tools here, blah, blah, blah. Okay, crossover there. In my assessment, I would have waited to see whether I'm going to see a breach below this level, which in my eyes was a quote-unquote valid support level, because we see the price action bouncing not neatly from that level, but reversing course quite rapidly. So that, in a sense, was acting as support level. If I saw a break, if I saw that signal and then a break below this kind of level here, then place a short order here and wait, okay? Now that we have an entry point, which is then, okay, we got the signal, we got the confirmation that the price action is moving to lower ground by breaching that support level, which is outlined here, okay? I have my indication price action will move to more, I have a higher chance of probability, quote unquote, high probability chance of making money on this. So placing a short order there. When would my exit position be? In a traditional sense, people that or traders that use the two moving average as a strategy, they await for the next crossover of the lines. So down there. Okay, so enter short there. Okay, understand, by the way, that this is a very, very, very long time horizon. Okay, and this applies, if not to string traders, to position traders. Okay, so we're talking about a period of 2020 until 2000 and too blurry, 2021. So more than a year and some. Okay, most traders do not have this kind of patience. Understandable. So the concept, however, is the same. In a sense, you are wait for the crossover, either bullish or bearish, and to enter the position after confirmation, and then exit the position. Where is the bloody mouse? Okay, and exit the position down there where you get the next crossover, because you see the green line crossing above the blue line, which is what we call the bullish cross. Okay, so it gives you an indication that the trend is maybe actually or has actually reversed course, not reverted, but still enter short there, cover the position there. That's one way of going at this. If you're talking a much shorter time frame and you don't want to wait for the next crossover, fair enough. Other traders like to pay attention at when. Okay, so in a sense, they take the simple moving average, the one simple moving average. Remember, we're using two moving average lines here. They apply the concept of the single moving average. Okay, that means whenever price action breaks above or below the single line, okay, they either enter or exit the position. Let me make this clear. For example, again, using the two moving average as your strategy, you get the indication that the price action is going to move to lower ground. You place a short order and you'll wait for when you're going to see a break, when you're going to see the shift or where you want to exit. Some traders may actually, let me get my pointer, may have exited somewhere in there once they saw a clear break above the single moving line. Even though they're using two moving average strategy, they use the single, okay, strategy. That's another way of finding an exit. They use the single line as their exit point whenever they see the price action breaking above it. They decompose this as an indication that, you know what, that shift in tide may be coming soon. Okay, so may have exited there. Or a third alternative to placing an exit may be whenever you see price action crossing above the long-term moving average, not the short, because the green one is the short, the blue one is the long. Okay, so we noted here 3 ways of finding an exit position, given that we have already an entry position in place. In this case, in our example, has been short. Okay, so now that we have the short position, I gave you 3 examples of where you can place your exit, because, okay, finding an entry point is something, fair enough, it's only halfway. Where is the exit point? Okay, we need to find a valid exit point, because you know what, you're not going to hold this forever. Okay, we know you need to place a trade, exit the trade, and carry forward with a new one. Okay, or you can keep playing this depending on who you are and what you like. But the point is, we have 3 alternatives here. Okay, so 3 alternative exit strategies. Given that we have an entry point, first option would be to await for the next crossover of the 2 lines. So much like it happened up there when we got the signal for a short. Down here gives you an indication, you know what, exit the position, or the shift, the trend is actually shifting. Pay attention, close the position, for example. Okay, so one is this is numero uno. Okay, second one for an exit point is whenever you take the principle of the single moving average, okay, and you see a break above it, place a short order, cover your position with a long order there, you're done. Okay, and the third alternative is using the long-term moving average, which is up there. Okay, notice here that in this specific example, okay, the most favorable scenario was to actually hold and wait for the next crossover of the two lines. Okay, exit point is down there. Okay, the second option, exit point is up there, and the third option is up there. Okay, but note that the actual, in this, again, in this kind of example, in this specific example, the actual exit took way much longer time compared to the prior two entries. Okay, so there is not a mix and match, but there is a trade-off, if you would like, that you need to pay, you have to take under consideration. Do I want to make as much as possible, given that I'm using the two moving average strategy and holding for as long as possible, or I'm going to use the two moving average in a bastardized way, using entry and then exiting on a much shorter time frame, much quicker. I'm going to be in and out much more quicker, but leave some sort of amount of money on the table. Okay, so this is a trade-off you have to come to in terms with in your own trading. Okay, so this ultimately depends upon your style, upon your personality, and the way of going at trade. Okay, but here I've outlined you 3 ways of going at using moving average lines as finding entry and then exit points. Okay, so is there a need to go from the other one? Yeah, why not? Okay, so next crossover was a bullish one. Okay, you see some sort of consolidation here. You see the two lines coming together. Okay, stalling of price action, relatively speaking, compared to the other price action. Okay, stalling, and then you see again green line breaking above the blue line, bullish crossover, or the golden cross gives you an indication to enter. Okay, more the shift is in favor, or the momentum is in favor with the bulls, therefore you capitalize on the upside. In my honest and humble opinion, I would like to saw a level break above this and this. Okay, these two levels, this area much more specifically would have been my area of paying close attention to whether to enter or exit this position, or whether to enter the position. I would have needed confirmation. As soon as I saw the break above this level, which acts as a resistance, okay, I would have liked to place a long order right above it or somewhere near this. Okay, after I get the confirmation that, you know what, this is actually in favor of the bulls and the price action will move to lower ground. I have the signal that the bulls have already taken over, because remember, it's a lagging indicator. After this, I want a confirmation. And when I see a definitive confirmation and break above this, enter a long position there, and I wait once again for the next crossover. Okay, when the blue line, when the green line crosses below the blue line, this is the opposite here. Okay, or I wait when I see touches for my exit point. Okay, much like the scenario numero duo we had here. Okay, at this point, I would have said enough is enough. Why not? I'm just covering my position, okay, making bank. And then, you know what, once I see a rebound from that line, okay, and a steep rebound after that line, and a break above this level, enter long once again. The indication is still there. The crossover has not yet taken place. You can actually close your position and then re-enter. Okay, so realize your profits. That means closing your position and making money. Okay, and then if you would like, re-enter the picture and do the same thing. Okay, again, something else to pay attention to. Okay, so well, we're already past. Okay, I'm gonna go what to expect in the next session. Okay, not yet done. Okay, let's go on a live environment to do the whole thing together. Once again, by also not only using two moving averages, but also adding into the mix the stuff that we've learned so far. For example, placing support and resistance levels. super basic stuff, okay? Finding a trend or drawing a trend line, or plotting on your chart an RSI, or a moving average convergence divergence, or a Bollinger Band, or all of them together. Let's do that together, okay? So we're gonna primarily focus, however, on the two moving average strategy, much like the one we saw in this slide, okay? We're gonna try to identify crossovers, okay? And then take into consideration everything else, what else is my indicators telling me, and hopefully gonna have some ideas to trade. Okay, so please bear with me to pull up chart here. What do we have? What do we have here? What is this? This is crude futures. So we're talking about crude oil. Okay, and on our chart we have what? We have, as you can see, Bollinger Bands. Okay, we covered this in the prior session, and the RSI below, okay, 14-day period. And we also have moving averages. So the yellow line or the gold line and the black line are the stuff we have talked about today. So let me firsthand get out of the way this. Let's get out of the way the RSI for the time being, okay, for the moment, okay? And let's focus on the moving average crossovers, okay? Much like we've done on the slide together, okay? So I have here in place a few support and resistance levels. Let's see whether they need some sort of update first, okay? So this level I pretty much like. If you draw it even further back, you can see this is where a nice gap up has taken place. I like this level, I support, so I'm going to keep it there. Definitely this one is another support level for me. This one is much more closer, but still kind of valid. We see some sort of traction or some sort of congestion taking place. We'll see about this for the time being. Maybe here is much more nicer, but still, you know what the price action is? Certainly below it. Well, let me get this out of the way. This is definitely not a resistance level because it broke above it. Remember, when we have price action and the price action is above a specific level we had in the past, much like the line I have here, okay? This is now a support level, okay? If the price action is above this level, it's definitely a support level, not a resistance level. The reason why I'm trying to make the distinction is because on this chart, and this is my way of plotting these things on the chart, the green line for me represents resistance, and the green line is, the red line serves as resistance, where the green line serves as support, okay? You can plot whatever colors you would like. You can color your lines however you like, yellow and blue, or I don't know, pink and purple. Nobody cares, okay? The point is place them correctly, okay? If, for example, the pink one means resistance and the purple one means support, the purple one must always be below the price action, and the pink one must be always above the price action in order to be a valid resistance and support levels respectively, okay? Again, details. So certainly this is not a resistance level, so I'm going to drag it up there. Support level. Now this is a resistance level at the prior peak. I like that. This is much more closer. You can draw it from there. And support, I would like to place another support level somewhere around there, because we see the bounce. And we're talking about on a much shorter time frame. The whole thing is not a short term, but I'm looking at it from a much shorter time frame perspective. So let's go for our chart, for example, okay? See whether the support and the resistance levels are still valid. Okay, the much older ones are still there. I'm not going to touch them. Okay, I'm going to use this level as 80, whatever that is, approximately speaking, as a support level. Resistance level, I'm going to use this and this, some sort of much more nicely here. Okay, so you see bouncing from these levels, okay, and then breaking below it, finding support there, and then failing to break above it. Okay, this is certainly a short-term resistance level that we'll be paying attention to. Other one is at the prior peak. Certainly I like this because it coincides with this. Beautiful. Okay. So you see price action bouncing from in the past. You can even draw it further back. Bouncing once, bouncing twice, 3 times, 4 times, 5 times, breaking below and then failing to break above it. Certainly a nice resistance level in my eyes. Okay. This is all in my assessment. And the last one is certainly somewhere up there in the peak, failing to break once, twice, 3 times, and then coming back down. Okay. So it's kind of asymmetrical. So they're not 5, for example, dollars each and every distance between each and every resistance level. I don't mind that. Okay. When it comes to support, definitely that one. Let's see about the prior ones. Let's go a little bit further back. Okay, this is going to be adjusted somewhere in there much more nicely. And even going further back. Okay. Because these two are much more closely together, I'm going to put it down there. Okay. And again, remember, we are talking and you have a much kind of similar kind of pattern here. You see the first two, the closest first and second support and resistance level, much more closely together, whereas the third ones are much more further away. Okay, gives us much more room to breathe. Okay, so because in a much more shorter time frame, we're going to be much more lenient, okay, for extreme scenarios for the price action to reach those kind of levels. Okay, so what else do we see here? We have descending kind of channel. Okay, once, twice, 3 times, and you have once and twice. Okay, we see a formation of a lower low here. Okay, might be laying into the price action soon. And we have also, let me zoom in a little bit much more. Okay, and you have also those two lovely moving average lines. Okay, in my case here, I have a 26 for the long one. Let's do it. Let's give it a value. Okay, let's go for an educational kind of scenario here. Let's do 100. Okay, to see how the line is behaving. Okay, and let's do 50 for the sake of the argument and for the sake of this example. Okay, to see whether we're going to get much. Basically, you're going to see how closely fitted the price action is. The lines are closely fitted to the price action, and whether you can spot by yourselves the crossovers and what actually they are telling us. Okay, so certainly here, let's go a little bit further back. Certainly here, we have a crossover. We have a period of consolidation for a brief period of time. So August 28th until the 30th. So 2 days of consolidation near this level. And you see the shift. So the yellow line, if you cannot closely see it, is the 50. And the black line is the 100. Therefore, and these are both exponential moving averages, you can use simple moving averages, besides the point. Okay, so the 50 moving average, okay, the exponential moving average is the short moving average, okay, the SMA, whereas the black line is the LMA, the long-term moving average. And what did we say? Whenever you see the yellow line, in our case, the short-term moving average crossing above the long-term moving average, the black line, so yellow crossing above black, you have a bullish crossover. Okay, so this is an indication for a bullish, okay, upside to be expected. Okay, and it has been the case. And you will draw, and you can also see the 2 lines, okay, moving to higher ground and the distance between them widening. Okay, the widening of the price action, the widening of the moving averages is due to the rapid pace of price appreciation. That means price action is moving to higher ground at a fast pace. Okay, so you can clearly see it there. And from this kind of perspective, let's do, okay, that's one line there where you could have expected to have some sort of stalling, and another trend line from down there up there. Okay, gives you an indication that the price action is moving to high ground. So for example, if you entered long there, please bear with me, you have to go anatomically from the past to the future, and then you're going to see in live on much shorter time frame. For example, I would have liked to place a long order there, and I discussed why, because I like to get the confirmation. Okay, let's not use that because it's going to mess up the whole thing. Let's use this. Okay, that was the closest resistance level that I wanted to see being broken, and then placing my long order in order to get a solid validation or a clue that price action is going to move to high ground. My exit point would have been somewhere around the crossover. I wouldn't have risked much more for a stop out. Okay, and that means, where will we get our exit point? And again, let's go use the 3 base scenario we just outlined in the past, because we have, in hindsight, we can actually do that. Okay, much more harder to do on an instrument at this point in time, because you don't know what's going to happen in the future. Okay, so a valid exit point from the traditional point of view would have been whenever we saw the next crossover. Where is the next crossover? Where do we see the yellow line crossing below the black line? Is certainly up there. And when it's up there, you would have actually gotten a price of this. Okay, this is where the crossover has happened. Therefore, in this kind of case, okay, the best you could have done, okay, by using the scenario where we said we're going to only play with where the crossovers of the 2 average lines, the moving average lines. So buy whenever you see a bullish crossover, and sell whenever you get a bearish crossover. This would have yielded the best result by using this strategy. Okay, this is one way of going at things. So you would have risked, but the risk reward ratio was 186. I wouldn't get out of the bed in order to place a trade like this. Okay, so in our case, we will go and see other, okay, alternative places, alternative points in time where you could have actually exited the position with much larger gains. And this would have been a little bit more time consuming, because you would have been paying much more closer attention to the price action rather than just waiting for the next crossover. So it would have, downside of the whole thing would have been that you would be placing much more attention and spend much more time stressing about when to exit. But still, it would have worth it definitely in our case. Okay, so in this case, the best we would have got if we got into a position somewhere in there and exited the position at best somewhere in there would have been 3.3%. Okay, decent, fair enough. Let's see what another alternative would have yielded us by using 2 moving averages, okay, with a slight modification. Okay, and the modification is we wouldn't have waited for the next crossover, which happened up there. We would have exited whenever we saw the price action closely breaking below the single moving line. Okay, single moving average, which would have been, in our case, and the best case I can see from here, somewhere in there. Okay, this is the area that you would have exited the position once you got the hint. Okay, let me use. Okay, so not using the next crossover as the exit point, but using whenever you're going to see the much simpler kind of perspective, a much more simpler approach, which is closing the position whenever you see the price action breaking below the short-term moving average, or treating the short-term moving average as a single moving average using the strategy we just mentioned in the slides. Okay, so exit point would have been here where we saw the price action breaking below. Give me one sec. breaking below the price action, breaking below the moving average, the short-term moving average. And this would have yielded what? How many percent? 8.16. Okay, so 8%. The other one was 3.3. Certainly, you would have left a little money on the table if you went from crossover to crossover compared to crossover with the break below the single moving average. Okay, you can see it visually together here. Okay, the other one would have been to await for the third scenario. So we mentioned crossover is the first one. Break below the single moving average is the second, not attempt, but second approach. Third approach would have been whenever you saw the price action breaking below the long-term moving average, which is the black line. In this case, is somewhere in there. Okay, so you note pretty much you would have yielded the same return by using not the traditional method, but a modified version of moving average strategy. Okay, a modified version of using two moving average as a strategy, and you use that, excuse me, to your advantage. Okay, so the return would have been 8.5. That was the prior one was 8.2. This one was 8.5. Relatively speaking, the same magnitude of return compared to the dismal, not dismal, but much less favorable take profit order that you would have got for 3.3%, or even lower than that if you would have been lucky. 3.3% for using crossover to crossover. Okay, again, this is highly dependent on the instrument. This is highly dependent on the current situation in the entirety of the markets. This is highly dependent upon fundamental data affecting various instruments, for example, crude oil. Okay, and therefore you have to take all this with a grain of salt. The point I'm trying to make here is that we introduced the concept of using two moving average as a strategies and then modifying it accordingly, or being much more vigilant in terms of high volatility and when to enter an exit position. Again, the whole point here is to grasp the concept why we use and how to use this. Okay, now it will depend upon the instrument whether you're going to be profitable or not. Okay, you can use the exact same strategy we just did today together, and you would not make money on this. Okay, it's just this. Okay, you know, the trading is a high probability game. Okay, it has to do with chance and probabilities. So therefore, amassing the highest amount of probabilities in your favor before placing a trade is your best case scenario at making money. Okay, and it doesn't work all the time, but you have much more confidence that it will go your way if you do your homework, okay, and your assessment on valid and solid grounds. Okay, and we talked about this many times. When you start adding many stuff to your charts, you get much more confident indications that, you know what, you are correct and you actually could make money on this. Now, when did we see, back to our example, let's have a few more minutes. Let's do another in-depth explanation. In this kind of case, when do you see another crossover? Plain and obvious, up there. So this is a bearish crossover. This is what we call a death cross. Okay, so an indication here is to sell. So completely the opposite case here. Okay, so let's assume that, let's use this lovely tool of replay. Okay, let's assume that we were here and the market is actually unfolding right before our eyes, and you see the break. Okay, you see the break below the two. Please do not rush and enter the short position. And so as soon as you see the indication, please use other stuff to confirm your own bias. Okay, so in our case, in the past, we have noted that this might be a valid support level, and you see bouncing once, bouncing twice, bouncing 3 times. Therefore, I will pay significant attention to this level, and I will only enter a short position once I see the break below this, a definitive break below this. okay? Because it could be bouncing on top of this for a prolonged period of time. It could even reverse course and move to high ground. The reason why you pay significant attention to this is because the two moving average lines are stuck on top of each other. That means they just have attempted to shift from the bullish side to the bearish side, okay? So that means there is a lot of high chances that there's going to be some sort of volatility here, and it's going to be a big fight between bulls and bears to see, okay, who is going to take the initiative and lead the price action next, okay? That's why we await for actual valid complete breakdown or break above a specific level that acted in the past as support or resistance levels. In this kind of case, my entry point would have been somewhere, if I'm not mistaken, we played this nicely, and you can see this on this latest report, okay? Would have been somewhere in this region, okay? Let's play the tape, okay? Here, if I've been fortunate enough, I would have been entering the position and would have had a nice target, most closely somewhere in there or down here, okay? So this was an area that could have used for an exit position, okay? Blindly, okay? This is not written in stone, but I would be paying significant attention to this kind of level as the price action unfolds over time, okay? So exit position would have been somewhere there, okay? And this is super early with the latest indication I have, okay? So please bear with me. Let's play the tape, okay? Super volatility, but you see the price action, okay? You would have been stopped out here, okay? But still the price action is moving to lower ground, okay? So that's one way to be super specific and also be super lenient with your stop out order. Never place your stop out order on the break point, okay? The break below. Give it some bloody room, okay? Because you have the prospect of the price action rebounding sharply, and we're talking about crude oil here. It goes all over the place. It's well renowned for doing this kind of movement, okay? Give it some leeway and let the price action unfold in the direction you expect it to, okay? In the first example I just given you, blindly and crudely without taking any other consideration, would have been stopped out, you see? If I just kept the position and set the stop out level at that prior prior support level that turned to resistance, I would have been stopped out by now. You can clearly see it here. It told you stopped out 1.1%. Still peanuts, but look what happened afterwards. It went your way. Okay, so again, do not listen to for you to keep an eye out. Okay, give it time and give it space for any possible rebounds from a crucial prior resistance level that has become support, okay, or support level that became resistance. Okay, be lenient. Okay, but let's, for example, don't put your stop loss up there. Okay, don't wait to lose 5.5%. Okay, be reasonable. Okay, that's why personally I like to use the past crossover at the initial stages as an exit position. Okay, in case something goes wrong, I will tolerate the price action to move up until there. Okay, not the prior resistance or support level. Crossover. This is my own personal bias. I like to do like this. You can do it as you wish. Okay, but the point here is you leave the price action to unfold, okay, and see whether it matches your trade. Do not go for way too narrow stop out positions or stop out levels, okay, or take stop loss much more accurately levels, okay. So, and you see the price action unfolding and moving to lower ground, and you see the distance between the two widening, okay. Again, indication that it moves to lower ground. You can plainly see it from the price action. Okay. And again, you pay attention to this. okay? That prior support level. It kind of revolved around here, and once again, it moves to the prior resistance level that we have outlined here. Prior support level that became resistance. It's going to challenge it once again. Now, when do we actually consider, okay, a valid exit point using only moving average strategies without support and resistance levels? So let me get this out of the way. Where would be what we be paying significant attention to? Again, you can use either of the three methodologies or three approaches I've outlined many times throughout this webinar. Either you await for the next crossover, okay, and you pay attention to the price action, okay? Is it going to be somewhere in here? Because you see the lines kind of flattening. Maybe they're going to start coming together. Or may some new fundamental kind of release come out in the market. For example, deterioration in the Israeli-Hamas kind of war, okay, which is going to impede some sort of the wider energy markets, not only in the Middle East, but on the international scene, or a large pile up of, for example, US stockpiles of crude oil that would push the price action to lower ground, okay? And they will widen this kind of band of the two moving averages. That means I will stay in the position much longer to await for the crossover. In this kind of case, again, you either await for the crossover, okay, or you await for the price action to break definitively, okay? It has breached above it at this level, okay? I'll wait for the price action to break definitively above the short-term moving average, okay? Maybe it's going to be somewhere in here. Or maybe price action will move to lower ground and the moving average line will come lower as well. That means you will not exit the position, okay? But at the back of your mind, you will be paying attention to this support level or this area much more closely in conjunction, okay? Crucial area for me would have been this, because that bounce over there is lovely, okay? Shift in the entire thing. This is where the tide has turned and we see the next leg up after the small retracement, okay? You see, first wave, pullback, second wave, pullback. Maybe this is the beginning of an actual reversal and not the extension of the price action to higher ground. Who knows? We'll assess the situation as we progress through time, okay? Paying attention on what's going on in the international markets. You don't just blindly open positions and just go away, okay? Pay attention to what's going on, okay? And this is an area certainly that I would be paying attention irrespective of the moving averages. But still, let's assume that the price action is going to do this, something like this, okay? Okay, and it comes down to this level, okay? Moving average certainly will be above it. So no indication from the short-term moving average, no crossover, no definitive crossover above the small moving average. Therefore, my position will be open. If I'm going to play out the crossover, it might happen somewhere in there. Or if the price action moves to lower ground, why not hold the position for, how many days is this? August 24th until November the 15th. So what, 3 weeks? Why have it open for 3 weeks? I might be, my patience might be wearing out and I'm going to be, you know what? I'm going to start at least covering or closing the whole of my position down here, okay? Because I expect some sort of rebound to take place from here, okay? There is a lot of ways to go at the whole thing. The point is to understand the way of thinking, and you can apply this irrespective of the instrument. Obviously, you need to know what is actually the driving force behind each and every move of any given instrument you're actually studying, but grasp the concept of, you know what, I have entered the position where my exit position will be, what my thinking about where my exit strategy will be. Okay, so I've outlined here many times. You could wait for a complete or an abrupt and solid breakup above the short-term moving average, the yellow line. You could expect to you could actually exit the position on a second scenario when you see the price action breaking above the long-term moving average. Or the third option is to await for that crossover. And again, these three scenarios fall under the moving average strategy. We have not taken into consideration any other indications. Okay, so let's do that for very, 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 very fast. Okay, so let's add to your charts Bollinger Bands, the stuff we have talked about the prior session. Okay, again, Bollinger Bands give you an indication of where the price action may be moving in a much abrupt and volatile way. And what we care about Bollinger Bands is whenever you see breaks below the lower bounds, okay, or breaks above the upper bounds, okay. Breaks below the lower bounds give us an indication that, you know what, a reversal or a rebound towards the mean may be expected. There's a lot of gibberish here. Please bear with me. Let's make the picture a little bit more clearer. Okay, let me move this out of the way as well. So when you look at the Bollinger Bands, we care about whenever we have breaks below it. When you have breaks below it, you could reasonably assume at relatively speaking short time frame, you're going to have a rebound, okay, a reversal towards the mean, towards the midline, which is what, yellow. Let me change this color. I don't like the color in this. Let's do it blue. Okay, so the midline, or okay, a break above it, which gives us an indication that an imminent, okay, reversal, okay, back again towards the downside or towards the midline is expected. So we pay attention to the moving, to the Bollinger Band as well, and the RSI here below. Okay, let's go with the Bollinger Bands. If and only if, let's maybe like this. Okay, so I would like to pay attention and for a possible exit, okay, whenever I'm going to see a severe break below the lower bound of the Bollinger Band. Let me see my settings here about the Bollinger Bands. Give me 1 second, guys. Sorry, I have to make something clear. You have 20-day small moving average and 2 standard deviations. Okay, so the standard, the default settings. Okay, so I would also be paying significant attention to whether I'm going to see a significant, a sharp and abrupt break below the lower bound of the Bollinger Band for me to keep an eye on exiting the position. Okay, so if I see a big candle like this breaking below that, I will certainly start paying attention for an exit. If, on the other hand, I see a break above the upper bound of the Bollinger Band, okay, that will give me much more confidence that the price action is going to move nicely and much more orderly to lower ground, reasonably expected to move back towards the mean, again, extrapolating from the concept of reversion towards the mean, okay, and I will leave the position a little bit more, I'm going to give my position a little bit more time to develop, moving towards lower ground, okay, and having much more chances of making a lot more money on this, okay. So what about the RSI? What is the RSI giving me an indication about? Okay, RSI below the chart is currently in quote unquote bearish territory because it's below 50. The 50 is the dot product line. It has been, excuse me, now it's on the 50 level. Okay, so the 50 level of the RSI, I mean, okay, you can see it attempting to bounce from it. The 50 level of the RSI below our chart gives us an indication that is currently some sort of indecision between who is going to dominate the next move. Is it going to be bulls or the bears? So values revolving around the 50 level, so 45 to 55, are considered to be some sort of area of indecision. So therefore, currently I do not have a clear direction of what's going on with the RSI, but I'm going to take into consideration its past move. So it has, rose from the 30, the oversold level. Okay, you see it down there, up there. Okay, up back towards the midline, the 50 level, the threshold. Okay, attempted to break above it, failed to, and then move to lower ground. Goes in my favor. Okay, so I'm also, this is the second time it falls near the 30, but not as low as 30. Okay, find some sort of consolidation. Okay, forms a cup, if you would like, and then rises back once again towards the 50 level, where is the cutoff point, the threshold. Now, if we see the RSI moving higher than this, then it will also coincide with a break above the small moving average. Okay, and that will send me a signal, you know what, it's time to exit. Okay, that's one way of interpreting this. If on the other hand, you see the price action moving a little bit lower, okay, and you see the RSI breaking once again or moving once again below the 50 level, okay, I hold on to my bearish bias scenario and I keep my position open, waiting for the price action to retest this kind of level and then move to this kind of area where I'm going to be placing much more attention to exit. Okay. Also, we'll be paying attention to the Bollinger Band. Also, we'll be paying attention to the divergence between the two lines of the moving averages. Okay. So you see how I'm adding to the mix a lot of different technical indicators. Super, super basic stuff, however, by the way, excuse me, you can do by yourself. And please understand the rationale of the way of thinking about these things, okay? This is what is the best way of, if you want to become profitable when it comes to trading, is to adopt this kind of assessing the situation and making scenarios kind of mentality on framework of or mindset, if you would like, at going at traders, at trading, excuse me. Okay, so this is not just placing an order and then just waiting for the wind to blow it towards my direction. No, be precise. Look at the indications that the technical indicators are actually giving you. Are they actually matching? Is my scenario well predicated upon valid data, or is it just a whims or a random kind of thought that I believe is going to be specific, do your homework, act like a sniper. Again, it's in your own best interest to go at trading with this. Okay, assess and compile as many indications as possible that either validate or disprove your theory or your assessment, and act accordingly. Okay, so again, in this kind of scenario, we keep our bearish bias in regards to the WTI, crude oil, until we see evidence proving the otherwise. Okay, so in this case we just mentioned, we held our position open. Let's just assume that we have entered this at the $85 range, something like that. Have an exit position. Again, this is my own personal bias. I like to place stop out level or stop loss level near the crossover. Personal liking or personal technique, whatever you want to call it. Either way, stop out would have been somewhere above this kind of prior support level that became resistance. Okay, much more valid. Not on the resistance levels, but a little bit more room above it. Okay, and you have, at least for the time being, a target. Okay, that you will certainly be pleased with to start closing your position, or either partially or fully. In my eyes, is this kind of region where we saw the prices bouncing from and then the shift. Okay, so this is my own personal bias. Okay, and we're talking about a 7% kind of target when it comes to gains. Okay, so if I see the price action failing to break below this kind of support level, and I see the RSI remaining, okay, above the 50 for, I don't know, 5, 6, 7 days, and I also see the Bollinger Band kind of widening, I would reconsider exiting the position here, if and only if I only see as well a break above. There's a lot of stuff here. I don't know if you can see what I'm doing. If and only if I also get the confirmation from the, let me move it here, from the break of the small moving average or the long-term moving average or a crossover, okay, depending on that. So all of that together, okay? So in this kind of case, if let's just say I'm going to exit somewhere in this range, we're talking about nearly 3.5%, 4% kind of gain. Again, decent risk reward ratio for taking out the position from here. Yep, sorry guys. Let me get this out of the way. Risk reward ratio specifically for this would have been what? 248, 250, 2.5. Decent. Okay. It's not 1-on-1. It's not 1.75. It's not 1-2, 2.5, 3. It's my kind of liking. Okay. Moderate kind of trade. Okay. But still, this is the rationale at going with these kind of things, using moving averages at first and then adding all the stuff together. Okay. So I think that is enough for today. Way past our time. Again, apologies for today's delay. Okay. Hopefully, guys, by the way, if you have any questions, please send them through before we finish. And during the next session, if I'm not mistaken, we're gonna go over Fibonacci. Let me give me a chance to see the calendar. Yep. If I'm not mistaken, next week we're going to do Fibonacci. Let's see. So if you guys have any questions in regards to this, please send them through before we finish. So next week we will cover moving average, convergence, and divergence strategy. Okay. So MACD. We covered the MACD session in the past. We're going to go again, reintroduce it, and do a live environment kind of thing as we did today. Once again, adding all the other parameters together. Okay. So this has been the end of today's session, guys. Thanks for watching, and we'll catch you until next week's webinar for our next topic, which is going to be MACD. For the time being, take care. Bye-bye. See you next week. Cheers. Bye-bye.